show you how to save money on your taxes by taking advantage of tax loss harvesting. Tax loss harvesting, if you're not familiar with it, is selling a loser, selling something that has lost money, and then essentially booking that loss. Realizing that loss is the actual official term for it. And at the end of the year, you can use that to offset either capital gains, or you can use up to $3,000 of that loss to actually offset active income. So it can be pretty valuable. So what that is, well, I can preface it by saying we've had a pretty volatile February, pretty volatile 2022 already so far when you're looking at the overall market. The market's pulled back pretty big yesterday, and a lot of people are looking at their portfolios and saying, hey, I've got some losses sitting here. Sometimes, and most of the time, the answer is you don't need to do anything. But if you're looking at, and I'll go ahead and point out here, if you're looking at a non-qualified account, so anything that is not an IRA, a 401k, SEP, or a simple, or a Roth IRA, then you can take advantage of tax loss harvesting. And so like I said, it's selling something while it's down, and it's booking that loss. So as a reminder, you're only taxed on capital gains. So that's when your sales price is more than what you paid for it. On the other hand, if say you if you bought something for $50,000, you sold it for $40,000, then you're going to have a $10,000 capital loss. At the end of the year, you're going to actually net out that $10,000 capital loss against any gains that you had for the year. If you have a net gain, then that's going to be taxable. But if you have a net loss, you're going to have two different options there. The first $3,000 of that is going to offset your active income. So if you're in the 30% tax bracket, or around the 30% tax bracket, that can be a nearly $1,000 tax savings at the end of the year. It can be beneficial. The other option is if you have, say you have $5,000 in losses. The first $3,000 will go towards your active income. Then the next $2,000 is actually going to carry forward to the next tax year. So you can always use it in future tax years. It's good to know. Beyond that, some things you need to know about are wash sales, the wash sale. The wash sale rule is a really boring way of saying you can't sell something on a Monday and buy the exact same thing the next day just to book the loss. It's a way that basically the IRS wants to make sure that any kind of sale that you have is an actual sale. So you can't sell something and buy it back within 30 days. Otherwise, the entire loss is going to be disallowed. So what you can do though instead is buy something that's very similar. So say you're investing in the S&P 500. You can sell the SPY and then immediately buy the S&P Growth Index. You can buy the S&P Value Index, for instance. That's totally okay. It just can't be substantially similar. Another option is if you have an individual stock. Say you own Ford and you really like Ford and you think that it's going to do great. But for right now, it's pulled back. You can sell Ford and you can buy you can buy a sector fund. Maybe it's one that actually covers all automakers. There are ETFs for everything these days. You can buy that ETF, hold it for 30 days, sell it, and then buy back Ford. That's still going to keep you exposure to Ford indirectly through that fund, and yet you're not going to be hit with the wash sale rules. So always something good to know, because you do need to stay invested, which goes to number 3, put that cash back to work. Don't sell Ford, don't sell SPY, and then let that cash sit there for 30 days, because the market might go straight up during that time frame. It's actually interesting when you look historically, the best days in the market come right after the biggest losses. You don't want to be sitting there and sell out at the bottom. So make sure you put the money back to work. That's all it comes down to. Even if you sell Ford and just buy back in the S&P 500, that's going to be better than sitting on the sidelines. So at the end of the day, the things that you need to know to save money on taxes are, anytime the market pulls back, you can look at your portfolio and see if you have opportunities for tax loss harvesting. You do want to make sure that they're all in non-qualified accounts, because like I said, if it's in a qualified retirement account, it doesn't matter. You can't use that because at the end of the day, it's all taxed the same. Beyond that, you also want to make sure that that money gets reinvested and that it's not reinvested into something that will trigger a wash sale rule. So be cognizant of that. If you have any questions, call your financial advisor. If you don't have a financial advisor, or your financial advisor doesn't talk to you about these things, call me. Call 606-316-1381. Shoot me an email at jeb@plentifulwealth.com, or go to plentifulwealth.com and click on the, I believe it says Let's Chat at the very top right, and you can get on my schedule anytime. So thanks, and have a great weekend.